Something is happening right now that the biggest banks in the world are telling their wealthiest clients about in private research notes, and almost none of it is reaching the people who need it most. Goldman Sachs, UBS, JP Morgan. Within a 48-hour window, all three published research that points in the same direction. The same asset, the same structural shift, the same conclusion about where the global monetary system is heading and what it means for the purchasing power of every dollar, euro, and pound that ordinary people have spent their lives accumulating. I have those reports. I have read them cover to cover. And what I want to do in the next 20 minutes is translate them.
Not summarize, not cherry pick the reassuring parts, but actually explain what these institutions are telling their largest clients, why it matters to you specifically, and what the convergence of central bank behavior, institutional positioning, and sovereign policy changes tells us about the reset that is already underway. Let me start with the word in the title, devaluation, because it is the most important economic concept that almost nobody truly understands until it has already happened to them. Devaluation does not require a dramatic announcement. It does not require a crisis headline or a market crash. It happens silently, continuously, and it happens to anyone who holds their wealth in a form that can be created in unlimited quantities. Your savings account pays you 4%. If you are with one of the large retail banks, it probably pays you closer to 1%. Meanwhile, the official consumer price index shows prices rising at approximately 5% annually. In real terms, in terms of what your saved money can actually purchase, you are losing ground every single month. Not because markets crashed, not because you made a bad decision, because the system is structured to transfer purchasing power from savers to borrowers. And the largest borrower in the world is the government that issues the currency you are saving in. This is not a new observation, but it has reached a new level of urgency. And the reason it has reached that level of urgency is visible in what Goldman Sachs, UBS, and the world's central banks are actually doing with their own capital as opposed to what they say in public statements. Let me walk through the Goldman Sachs position first, because it is the most direct. Goldman Sachs is the most influential investment bank in the world in terms of its impact on institutional capital flows. When Goldman's senior commodity analysts publish a research note describing their posture toward an asset as constructive, which is the institutional vocabulary for bullish, for believing prices will rise, that note moves capital, funds adjust positions, allocations shift. The word constructive in a Goldman Sachs research note published after a 12% monthly decline in an asset means the sale does not change our view. We are still buying. That is what they said about gold after its worst monthly performance in 13 years after a decline that many retail investors interpreted as the end of the gold thesis. Goldman's analysts are explicitly connecting their bullish posture to three factors: the sustained inflationary pressure created by the Middle East conflict and its effect on energy prices, the Federal Reserve's inability to cut rates aggressively given that inflation context, and the long-term fiscal trajectory of the United States government, which is spending money it does not have at a rate that has no historical precedent outside of wartime. The fiscal point is the one I want to dwell on because it is the foundation of everything else. The United States government currently carries a national debt above $38 trillion. The annual deficit, the amount by which spending exceeds tax revenue in a single year, is running at approximately $2 trillion. The interest payments on existing debt have now surpassed the entire defense budget as a line item in the federal budget. This is not a future problem. It is a present reality. And it creates a constraint that determines everything about how monetary policy will eventually have to respond. When a government spends significantly more than it collects in taxes, it has two mechanisms for closing that gap. The first is to borrow, to issue debt, and pay interest to whoever buys it. The second is to monetize, to instruct the central bank to create money and use it to purchase government debt, which is another way of saying print money. The first mechanism is sustainable as long as the interest rate on that debt is manageable relative to the government's revenue. When the interest burden becomes large enough, as it already has, the government faces a choice between painful fiscal consolidation that is politically accommodation that gradually erodes the value of the currency. Every major government in the developed world is choosing the second path. They are choosing inflation over austerity, and they will continue to choose it because the political consequences of the alternative are unacceptable to elected officials. This is why Goldman Sachs is constructive on gold after a 12% decline. Not because of a trade, because of an arithmetic reality that cannot be resolved without a sustained period of currency debasement, which is in precise terms what the title of this video means by devaluation. Now, let me turn to what UBS is telling its clients because the Swiss perspective adds a specific and important dimension to the Goldman view. UBS identifies four primary drivers for gold in the current environment, and I want to go through each of them because together they form a comprehensive picture of the structural forces at work. The first is stagflation risk. Stagflation is the condition where prices rise and growth slows simultaneously, where you get the worst of both worlds. Inflation without the economic expansion that would normally accompany it. It is the condition that the Federal Reserve is least equipped to handle because its primary tool, interest rate adjustment, works against one problem while worsening the other. Cut rates to stimulate growth and inflation accelerates. Raise rates to control inflation and growth slows further. The central bank is paralyzed. And in every prior stagflationary episode, the 1970s being the most instructive example, gold has been one of the strongest performing assets precisely because it is outside the monetary system that is failing to maintain price stability. UBS is explicitly flagging stagflation as a serious and underpriced risk in the current environment driven by the combination of energy price pressures from the Middle East conflict and the structural growth headwinds created by tariffs, geopolitical fragmentation, and tightening credit conditions. The second driver UBS identifies is dollar weakness. The dollar's reserve premium, the excess demand for dollars relative to what the U.S. economy's fundamentals alone would generate, has been the primary mechanism suppressing gold's price for decades. When the dollar is strong, gold is expensive for non-dollar holders, which suppresses international demand. When the dollar weakens, gold becomes relatively cheaper for the majority of the world's population, which expands the demand base. UBS's medium-term view is that the dollar will weaken from current levels. The basis for this view is the fiscal reality I described: sustained deficit spending, monetization risk, and the gradual erosion of confidence in the dollar's reserve status as sovereign nations observe the weaponization of dollar-denominated assets against Russia and draw their own conclusions about the risks of dollar dependency. The dollar does not need to collapse for this dynamic to matter. A gradual sustained weakening over several years, the kind that does not generate dramatic headlines but continuously reduces purchasing power, is sufficient to constitute a major structural tailwind for gold. The third driver is lower interest rates. This is perhaps the most counterintuitive element of the current thesis, given that the Federal Reserve is currently constrained from cutting rates by inflation. But UBS is making a medium-term argument, not a near-term one. The debt arithmetic I described, $38 trillion, growing deficits, interest payments exceeding the defense budget, creates a fiscal pressure that sustained high rates cannot indefinitely accommodate. At some point, the interest burden becomes politically and economically intolerable, and the Fed faces irresistible pressure to reduce rates, even in an inflationary environment. When that happens, and UBS's analysts believe it will happen within the medium-term horizon, they are analyzing, the real yield on dollar-denominated assets falls. And when real yields fall, the opportunity cost of holding gold falls with them, which removes the primary short-term argument against owning an asset that pays no coupon. The fourth driver is central bank buying, and this is the most structurally significant development in the gold market over the past several years. According to the World Gold Council, central banks globally purchased over 1,000 tons of gold last year. This is not a record anomaly. It is the continuation of a trend that has been building since approximately 2010 and has accelerated materially since 2022. Gold now represents approximately 20% of emerging market central bank reserves, a level that would have seemed implausible a decade ago. And the central banks that are buying are not doing so because they ran a model showing gold will appreciate. They are buying because they are reducing their exposure to a reserve system that is demonstrated through the freezing of Russian assets that it is subject to political discretion rather than rule of law. This is the deepest and most durable driver of the structural gold thesis. The dollar's reserve status was built on a foundation of trust. The trust that U.S. institutions would honor their obligations to foreign holders of dollar-denominated assets regardless of the political relationship between the United States and the asset holder. That trust has been structurally compromised. It cannot be fully restored by a policy statement or a diplomatic gesture. The precedent has been set, and every sovereign treasury and central bank on the planet has adjusted its risk calculus accordingly. Now, I want to address something that I think is genuinely important for anyone trying to make sense of the recent price behavior. Gold just had its worst monthly performance in 13 years. If you own gold, you experienced that drawdown. And the natural question is, does this change anything about the thesis? Is the 12% decline telling you something? Goldman and UBS analysts are not. The answer requires understanding why the decline happened. The actual mechanism, not the headline. The decline was a liquidity event, not a fundamental reassessment of gold's value. Here is what occurred. The Middle East conflict caused oil prices to spike sharply, which produced mark-to-market losses across virtually every asset class except energy. Hedge funds, which operate with significant leverage, sometimes 40 times their equity capital, faced margin calls across their portfolios. When you are leveraged 40 times and a position moves against you by a small percentage, the loss relative to your equity is catastrophic. You need cash immediately to meet your margin obligations. And when you need cash immediately, you sell what you can sell quickly, not what you want to sell, but what the market will absorb at volume. Gold is one of the most liquid assets in the world. It is available for immediate sale at scale at any hour of the day, any time zone. So, leverage funds sold gold not because they believed gold was overvalued, but because gold was the most convenient source of liquidity in a moment of acute portfolio stress. The analogy that makes this precise. A homeowner who loses their job does not sell their house because the house has become a bad investment. They sell it because they need cash. The house's fundamental value, location, structure, neighborhood quality has not changed. The seller's liquidity situation has gold was that house. The institutions selling it were not expressing a view about gold. They were expressing a view about their immediate cash needs. The evidence for this interpretation is visible in the physical market data. During the same period when the paper gold price was declining, when comps futures were being sold aggressively by leveraged funds, the registered inventory of physical gold and comps vaults was also declining. Physical gold was leaving the system. Delivery requests were at elevated levels. If the selling had been a genuine fundamental reassessment of gold's value, you would expect physical demand to also weaken. Instead, the buyers of physical gold, the ones who want the actual metal rather than a paper claim, were accelerating their accumulation at lower prices. The paper market and the physical market told opposite stories. The paper market said panic. The physical market said opportunity. This divergence between paper and physical is one of the most reliable signals in the gold market, and it has a consistent historical interpretation. When paper prices fall but physical demand rises, the paper market is mispricing the asset relative to its physical reality. The correction is not sustainable indefinitely. Eventually, the physical market signal dominates. Now, let me address the China dimension because it is the most structurally important development in the gold market that Western financial media has almost entirely ignored. China's financial regulators recently authorized a program permitting 10 major insurance companies, including PIC and China institutions managing assets in the trillions of renminbi, to allocate up to 1% of their total assets into gold. UBS analysts who traveled to China specifically to assess this development found that Chinese gold ETF inflows remained robust during the period when North American ETF flows were significantly negative. Trading volumes on the Shanghai Gold Exchange increased, and the insurance company allocation program has not yet reached its authorized limit, meaning the capital that has been approved to flow into gold has not yet fully arrived. 1% of the assets managed by China's major insurance companies represents approximately 27 billion US of potential gold investment. That figure is likely conservative because the program may be extended to additional institutions and the percentage allocation may be increased as the pilot proves successful. This is not a quote short-term trade. Insurance companies are among the most long-duration investors in any market. Their investment horizon is measured in decades. When they build a gold allocation, They do not sell it in response to a monthly price fluctuation. They hold it, they add to it, and they represent the kind of structural long-duration physical demand that the paper market short-term volatility cannot sustainably suppress. The pattern here, Western paper market participants selling, Eastern physical market participants buying, is a transfer of gold from leveraged short horizon holders to unleveraged long horizon holders. Every time this transfer occurs, the pool of gold available for future force selling shrinks and the base of committed long-term holders grows. The implication for future price dynamics is not subtle. Let me now give you the 3 analytical questions that I think are most useful for evaluating any asset in the current environment. Not just gold, but any significant allocation decision. The first question is, what are the most well-resourced institutions in the world actually doing with their capital as distinct from what they are saying publicly? Actions and statements frequently diverge. Public statements are designed to manage perception. Capital allocation decisions reflect actual conviction. The answer to this question right now is unambiguous. Central banks are buying gold at the highest sustained pace in decades. Chinese institutional investors are building their largest ever gold allocation through a regulatory program that has received minimal Western coverage. Goldman Sachs is constructive on gold after a 12% decline. UBS is telling its clients to stay bullish. These are not opinions. They are observable capital allocation decisions and published institutional research notes. When the institutions with the deepest analytical resources and the longest investment horizons are converging on the same asset simultaneously, that convergence deserves serious analytical attention. The second question is, what is the crowd doing, and what does that tell you about where we are in the sentiment cycle? Retail investors sold equities and gold aggressively throughout the period of acute crisis. The sentiment readings were at extreme levels of bearishness. This is important not because retail sentiment is a reliable predictor of direction, but because the positioning it creates maximum negative exposure defines the setup for the next move. When everyone who is going to sell has already sold, the marginal buyer determines the next direction. And the marginal buyers in this market, as I have described, are the institutions that were waiting for exactly this type of liquidity-driven dislocation to build positions at distressed prices. JP Morgan's own data shows that when U.S. equity positioning has been as bearish as it currently is, the S&P 500 has delivered an average return of approximately 8.2% over the following 3 months. That is a historical average, not a guarantee, but it reflects the mechanical reality of sentiment-driven markets. Maximum pessimism and maximum opportunity tend to coincide. The third question is, are the structural forces driving this thesis long-term or short-term? Are they likely to intensify or dissipate over the next several years? The structural forces behind the current gold thesis, fiscal excess, monetary debasement, dollarization, sovereign reserve diversification, are not cyclical. They did not emerge from a single policy decision, and they will not be resolved by a single policy correction. The U.S. fiscal deficit reflects structural spending commitments and structural revenue constraints that have been building for decades. The dollarization trend reflects a geopolitical reality. The weaponization of dollar-denominated assets that cannot be undone by diplomatic gestures. The Chinese insurance allocation program reflects a regulatory decision that will compound over years as the program matures and potentially expands. These are multi-year forces operating in the same direction, reinforcing each other. The reset that is underway is not a market event. It is a monetary event. The gradual sustained devaluation of fiat currencies relative to scarce physical assets is the mechanism by which governments resolve the tension between their debt obligations and their inability or unwillingness to reduce spending. It has happened before. It is identifiable in the historical record of every major fiat currency over multi-decade periods. And the institutions that understand this mechanism are positioning for its continuation quietly, systematically at the prices that short-term volatility has created. The people who get hurt in a monetary reset are not the ones who bought the wrong stock. They are the ones who held their wealth in the asset being devalued. Cash, fixed income, savings accounts. While the institutions that understood what was happening quietly moved their capital into assets that maintained purchasing power across the debasement cycle. Understanding the mechanism is the first step to not being on the wrong side.